Hi, guys, and welcome back to the podcast. I'm your host, Irene. We are getting into 2026. We know that the ISA rules are going to be changing from 2027 in the UK. And to get us prepared for our financial journey in 2026 and get ready for the changes coming in 2027, I'm going to be covering bonds today and again later this week to help you understand how bonds work, and why you should be thinking about them as well. Pension funds have them, and should you potentially be considering them for your portfolio as well. So let's jump straight into it. Now, a bond is a debt, right? It's a form of debt which you're issuing to corporates or to the government. So they are borrowing money from you. And for them to borrow that money, they have to let you know how much you're expecting to get as a return on your investment. So, how it works is they'll have what we call a coupon, which is the interest rate that is attached to the specific bond. So, it could be a bond with a 5% interest rate or a bond with a 10% interest rate, depending on what they're issuing and how much they're looking to raise. Now, when that bond is issued, you can get the interest over the duration of that bond. You have money coming in monthly, quarterly, biannually, annually, depending on how it's structured. At the end of that bond, the life cycle of that bond, which you call the maturity, you get your money back that you invested into that bond. So, what's good for you to consider? The duration, which is how long are you going to hold that bond for? And this is where we now approach your own personal investment strategy. So, I'll tell you how pension funds are considering the duration of the bonds. They have a very specific goal in mind. They have new investors and they also have long term investors, people who are approaching retirement who will need to start receiving cash from their investments. And the risk profile across the the spectrum in a pension fund differs. So for the younger savers, they have a higher risk profile, which means they have the opportunity to make high risk investments, and should that not work in their favor, there's time to recover those losses. Equally, it's good to start getting those high returns earlier on so you can benefit from compounding over the life cycle of your pension investments. Now, for the older investors who are approaching retirement, it's a different strategy. You will be put onto more, I guess, what they call safer investments. No investment is fully safe, which is why I'm saying safer in quotes, right? They will put you into more safer investments, which means that your portfolio is going to be more bond heavy as opposed to a younger investor whose portfolio might be more equity heavy. So, what pension funds are looking for, is the interest on the bonds, which means that they're receiving regular income so that they can meet their liabilities at different points within the year, within the life cycle of that bond. Again, they do want to get that money back. They don't want your money to be lost completely. So they're also looking for investments which are going to give that money back at a point in time, depending on the commitment of that fund. Now, for your personal situation, you need to think about how long you want to hold that investment for. It could be 3 months, it could be 18 months. If you're looking to save for a house, that might be a potential place to put your money. It could be a more sort of mid-term, long-term investment, which is 5 years, 10 years, 20 years, 30 years. So the reasons for holding different duration of bonds varies based on your personal scenario. So I would not be surprised to see a pension fund holding a bond for up to 20 years, up to 30 years. I mean, different risks are associated with all of these anyway. So let's just think about it from a personal perspective and what you're looking for. Because even making that long term decision for 30 years is not something you can really guarantee. So maybe you want to look at it from a more short term, mid term perspective, 5 to 10 years, 3 to 18 months, whatever works for you, right? Now, we've talked about the risk profile. Younger people have a higher risk profile than the people approaching retirement. So, when it comes to bonds, how does this work? Bonds within themselves have their own risk profile. I say that they're sort of like safer in quotes because not 100% bulletproof, but within the profile of bonds, you have bonds which are higher risk and bonds which are lower risk. So the concept remains the same: higher risk, higher returns, and that's something that you need to look out for. If you have a bond with a risk profile of 7, which means it's high risk, in theory, you want it to have a higher return than the bond with a lower risk profile. If that switches for any reason, you want to get into the detail to understand why is a higher risk bond returning a lower interest, for example. So as I've said, the interest is like could be 5%, could be 10%. That's what you call the coupon. And then the duration is how long you're holding the bond for. And the face value is also something that we'll talk about in another video to help you truly understand how bonds are priced, how they're bought at different prices, and how that links to the interest rate as well. So, because the government is changing the rules, we're moving from holding a maximum of 20k a year in cash to holding a max of 12k in cash, and the rest to keep your ISA allowance. The requirement is for you to put the remaining 8k in investments. Bonds are an interesting way for you to get your feet wet. If you've not been investing before, that's definitely one for you to consider. They're considered to be, like I've said, safe, safer than equity investments. They are fairly stable in terms of the return. It's predictable. If you get a 5% interest bond or 5% coupon bond that for the next 5 years, you're going to get 5% interest consistently. That is fixed, right? And in terms of the risk profile between bonds and equities, bonds have a lower risk profile, which means you're not taking too much risk as an investor. And so it's a good way for you to get yourself into understanding investing. And if 2026 is the year for you to get your feet wet, I would definitely say look into investing in bonds maybe in 2026, get your feet wet, understand how bonds work, see how comfortable you are with how that performance is working. When you get into 2027, where it's now okay, you can no longer hold cash, then at least you started with bonds and now you can begin to progress into equities and other types of investing. So I hope today's episode has been useful in terms of giving you some insights into bonds, and later on this week I'll be continuing with the conversation on bonds to expand on it a little bit more just to give you some more insights. So thank you so much for joining me today and I'll see you next time. Bye for now.